Are you an apartment owner or real estate investor and you're thinking about either selling your property or maybe you want to grow and diversify your portfolio? Well, a 1031 tax-deferred exchange might be right for you. I'm Lauren Capwell with Sage Real Estate, and today we're going to talk about everything you need to know to do your 1031 tax-deferred exchange. Today we're going to talk about what is a 1031 exchange, who is it for, is it right for you, how it works, so all of the rules and timelines that are involved, and finally, the next steps for you to take to get started. So what is a 1031 exchange? A 1031 exchange is a tactic that wealthy investors use in order to grow and diversify their real estate portfolio without paying any capital gains tax. So basically, you're trading one asset into another and it defers taxes into the future. So who is a 1031 exchange for? Well, if you've owned property for a little while and you want to take the equity that you have in that property to grow and diversify your real estate portfolio, 1031 exchange is the perfect way to do that. So one of the major benefits of a 1031 exchange is that it allows you to defer paying capital gains tax, which frees up all of your capital to put down on a replacement property. So as an example, in California, if you own a property and you've got maybe about $1 million worth of equity, capital gains tax in the state of California is anywhere from 20 to 24%. So if you were to just sell your property and have to pay capital gains tax on your $1 million of capital gains, that's about $200,000 to $240,000 in tax that you would have to pay, meaning that you would pocket only about like $760,000 to $800,000. So when you go out to buy a new property with that money, all of a sudden, what you can afford is now diminished. The benefit of a 1031 exchange is that it allows you to take 100% of that $1 million and put that down on a property, which gets you into a much larger property. So another benefit of doing a 1031 exchange is that it allows you to grow and diversify your portfolio. If you think of your money like an employee, you always want to make sure that your money is working as hard for you as it possibly can be. This is really great if you have properties that are underperforming. They're not cash flowing as well as you like. Maybe you have other problems with them and you're just really ready to trade in for something else, or you want to grow and diversify your portfolio. This is a great option. So by repositioning yourself, which basically means going from a smaller property into a bigger property, or from an underperforming property into one that's actually going to perform the way that you want it to, you can maximize the returns on your real estate investment portfolio. Also, a 1031 exchange allows you to maximize your return on equity. Return on equity is a little known real estate investment formula that's extremely powerful, and it will help you determine if your property is performing really as well as you think it is. One thing that we see a lot with investors, if they bought a property 10 years ago, 20 years ago, which the price back then compared to today, super low compared to what the rents are now. It appears as if the property is cash flowing well. They seem very happy with it, but what they don't realize is that they have a lot of their own equity tied up in this property. And what happens is that the money basically gets lazy over time. The longer that you own your property, the more equity you build, but also like the return that you're getting for that equity declines with time. This is a really powerful formula that's going to help you determine if a 1031 exchange is right for you and if it's time to sell the properties that you have. So if you want to grow your wealth and you want to build your real estate portfolio, this is what you've got to do. This is what the wealthy investors are doing, and this is how it gets done. Okay, so now you're convinced. You know that doing a 1031 exchange is the right decision for you. But what does that even look like? Let's go take a look at the timeline and how it all works. So the first thing to do, it starts with the sale of your property. You sell your property and the proceeds of that sale, which are called the boot, go and they're held by a qualified third-party intermediary. So you never get to touch the funds. All of those funds are held in an account by a third-party intermediary. From the sale of your property, you have up to 45 days to identify a property to purchase. So there's multiple ways that you can do that. There's 3 different rules for how to identify potential properties that you could purchase in your 1031 exchange. Now, after that, you have an additional 135 days to close on those replacement properties. So when you identify the property that you're going to purchase and you go to close, at that point, the funds are released from the third-party intermediary and are transferred for the sale and purchase of your new property. The really important thing in all of this is that you have 180 days from the sale of your property to close on a replacement property. And from the sale of your property, you also have up to 45 days to identify replacement properties. Now, you could shrink that timeline down. You could identify replacement properties in 10 days or 20 days, and then you have the remainder of the 180 days, whatever's left, to close on the sale. So let's talk about the 3 rules for how to identify potential replacement properties for your 1031 exchange, because this part can be really confusing. So rule number 1 is called the 3 property rule. For the 3 property rule, this is something that you want to use if your intention is to trade up. So you want to trade your 1 property and you want to get properties typically of greater value. You want to go to a single bigger property. The 3 property rule is probably what you're going to use. So basically what it says is you can identify up to 3 properties of any value and you must close on at least 1 of them. So in this example, we have 123 Boot Avenue, which is your property. You just sold it for $1.5 million. When you do your 1031 exchange, this is also important. What you exchange into is based on the sale price, not your equity. What this would look like for the 3 property rule is you could identify another property of equal value, another property that's $1.5 million, or you could identify a property that's $4 million or a property that's $7 million. Up to 3 properties, any value of equal or greater. That's the 3 property rule. By the way, these 3 rules are all ors. You can use the 3 property rule or this 200% rule that I'm going to talk about. Now, moving on to rule number 2, this is another option for identifying properties. This is called the 200% rule. Now, if you're looking to diversify your portfolio, you're gonna probably wanna use the 200% rule. The 200% rule says that you can identify unlimited properties as long as their total value doesn't exceed 200% of the sale value. And so what that means is you sold Boot Avenue for $1.5 million. That means you can identify unlimited properties as long as their combined value doesn't exceed $3 million. So here I'm showing 5 different properties. When you total all of their value together, these 5 properties equal $3 million. Now, this one isn't used very often. Probably about 95% of exchanges use the 3 property rule that we discussed previously. But what happens if you break both of these rules? What happens if you've identified more than 3 properties and their total value exceeds the 200% rule? So that is what we call the 95% exception. This one is very, very rarely used, but I'll go ahead and share it with you. So you've identified more than 3 properties and their total value is greater than 200% of the property that you just sold. What this says is that you must acquire and close on at least 95% of these properties. Here's our example again, 123 Boot Avenue, $1.5 million. You've identified all of these properties here. And when you total their total value is $7 million combined. And that means you must close on $6.65 million worth of these properties. So in this example, you could fail to close on this $150,000 property here, and you would still meet this requirement. You would be closing on more than $6.65 million worth of properties. That's the 95% exception. And those are the 3 rules for property identification and a 1031 exchange. Oh, and by the way, when you're identifying properties, they have to be a like-kind property. Now, what that means is that if you have an apartment building, you cannot 1031 exchange into a single family residence for yourself to live in. You can't 1031 exchange into a house that you want to go flip. Basically, what like kind means is that you have one investment property that you purchased with the intent to hold. You need to go buy another investment property also with the intent to hold as a long-term investment. So you could trade your apartment building for a shopping center, you could trade it for another apartment building. It just has to be something that you hold as a long-term investment. So if you're interested in a 1031 exchange, really the place to get started is first of all, figure out what's your return on equity. If you have a real estate agent that you're already working with, you can go and talk to them. Just be prepared that a lot of real estate agents don't know this formula. I wasn't joking when I said that this is like a little known formula in real estate investing. I know that some situations are complicated, and so if that's you, and you'd like a little bit more help, you can always come to us. We will help you figure out how your building's performing, what's your return on equity, and really get into all of the details with it. So once you've determined your return on equity and you've seen that you could be doing a lot better out in the market, really like the next step is to list your property for sale to enter the 1031 exchange. So what you'll need is to talk to a real estate professional, and you'll also want to make sure that you're working with a qualified tax professional who deals with 1031 exchanges. So that's the next step, is to sell your property. Probably you'll need the equity, the payout that you get from selling your property in order to put the down payment on the replacement property. And that's everything you need to know. If you have any questions about 1031 exchanges, what is your return on equity, or if you're interested in selling your property, please reach out, like, comment, and subscribe, share this video, and I'll see you guys next time.